Hello guys, in this video we will talk about should I invest or pay off my mortgage. So let's start. If you have received a windfall of cash or saved a sizable sum of money over the years, it may be tempting to pay off the mortgage loan early. Whether or not paying off the mortgage early is a good decision or not can depend on a borrower's financial circumstances, the loan's interest rate, and how close they are to retirement. Another consideration includes whether to invest that sum of money versus paying down the mortgage. This article explores the interest cost that could be saved by paying off a mortgage 10 years early versus investing that money in the market based on various investment returns. How a mortgage loan works. A mortgage is a loan to a borrower for the purchase of a property or home. When all of the legal documents are signed during the mortgage closing, the borrower signs the loan documents and agrees to repay the mortgage lender in monthly payments until the loan is paid off. Typically, the loan term is 15-30 years. In return, the financial institution pays the seller the full price of the home and in exchange charges the borrower interest on the loan balance. Principal and interest. Mortgage payments are made up of two components: interest on the loan and a principal amount, which goes to paying down the total outstanding balance. For example, a $1,000 monthly payment might have $300 go to interest and $700 reduce the principal loan balance. Interest rates on a mortgage loan can vary depending on where interest rates are in the economy and borrower's creditworthiness. Amortization schedule. The loan payment schedule over a 30-year period is called an amortization schedule. In the early years, the payments for a fixed-rate mortgage loan are mostly composed of interest. In the later years, a larger portion of the loan payment is applied towards reducing the principal. For example, in the 20th year, $611.45 went towards principal, while $286.64 towards interest. For the last payment, all but $2.61 of the monthly payment went toward paying the principal balance. The portion of the loan payment that's applied to principal and interest changes over the years because the loan balance is higher in the early years and smaller in the later years. This makes sense since the interest amount is higher early on, since there is a larger loan balance outstanding. As the monthly payments eventually reduce the outstanding loan, there is less interest owed, leading to a smaller portion of each payment being applied towards interest and more towards the principal. Paying off the mortgage early. Some homeowners choose to pay off their mortgage early, and the benefits can vary depending on a person's financial circumstances. For example, retirees may want to reduce or eliminate their debt since they are no longer earning employment income. In other cases, people may want to free up their monthly cash outflows by paying off their mortgage. Interest saved from paying off mortgage. For the mortgage with the 3.5% interest rate, the total interest cost for the 30-year loan would be $123,312, and the borrower would save $20,270 by paying it off 10 years early. Also, saving more than $20,000 in interest is significant. The interest amount saved represents only 17% of the total interest cost for the 30-year loan. In other words, $103,000 in interest has already been paid in the loan's first 20 years, representing 83% of the total interest over the life of the loan. As mentioned earlier, the structure of the amortization schedule for a mortgage leads to most of the interest being paid in the early years. Investing in the market. If a homeowner is considering paying off their mortgage early, it might be worth considering whether some or all of those funds would be better off invested in the financial markets. The rate of return earned from investing might exceed the interest paid on the mortgage for the final 10 years of the loan. In other words, the opportunity cost, meaning the foregone interest that could be earned in the market, should be considered. However, many factors go into evaluating an investment, including the expected return and the risk associated with the investment. Investment gains versus loan interest saved. If a homeowner decided to invest $1,000 versus paying down their mortgage in 10 years, they would earn $22,000 based on an average rate of return of 2%. In other words, there would be no material difference between investing the money versus paying off the 3.5% mortgage. However, if the average rate of return was 5% for the 10 years, the homeowner would earn $62,000, which is more money than the interest saved in all three of the earlier loan scenarios, whether the loan rate was 3.5%, 4.5%, or 5.5%. The power of compounding. One of the reasons for such a difference between the investment gains and the interest saved from paying the loan off early is the power of compounding. If the $1,000 investment is not withdrawn during the 10 years, the interest earned each year is reinvested, leading to interest being earned or on interest, which can magnify the investment gains. Risk tolerance. Before investing money in the market, it's important for investors to determine their level of risk tolerance, which is the amount of money they are willing to risk in order to make an investment gain. Risks of different investments. There are various types of investments to choose from, and each has its own risk associated with them. For example, treasury bonds would be considered low-risk investments since they are guaranteed by the US government if held until their expiration date or maturity. However, equities or stock investments have a higher risk of price fluctuations called volatility, which can lead to losses for the investor. Going back to our example, if the homeowner decides to invest their money in the market instead of paying off the mortgage 10 years early, there is a risk that some or all of that money could be lost. As a result, if the investment loses money, the homeowner would still need to make 10 years worth of loan payments. So guys, we will end this interesting for you video. Goodbye.